Friends, I'm going to do a series of three podcasts on the mutual funds investing. Investing in mutual funds is growing in our country. A lot of people are getting into the culture of mutual fund investing. They are using mutual funds as their vehicles for their retirement corpus. A lot of faith is being shown in mutual funds like never before. The SIP books of mutual funds were in recent months hitting their all-time highs. So people were getting into a habitual, systematic way of saving for their future through mutual funds. Given this scenario, it's important to understand how mutual funds are performing, why they are doing well or not doing well, and what it takes to be a successful mutual fund investor in the future. In the first podcast, I'll tell you about how mutual funds have done in the last 1 year. In one line, the performance has been unimpressive. Mutual funds across categories have not done well. In fact, they've underperformed fixed deposits and gold by a wide margin. To give you some numbers, the large cap category of mutual funds, which invests in the top 100 companies listed in India by value, have returned something like minus 20.71% in the last 1 year. We were told that if you want to build a stable corpus, invest across category and go for a large and mid-cap approach so that you have exposure to both segments. If you see how that category has performed, it's lost 19.68% in the last 1 year. Typically, these funds invest in the top 250 companies listed in India by value. This is also not done well. If you see how the small cap companies have done, that is, the companies from 251 by value onwards, they have returned a negative of 25.61%. So that's another big minus. Then to the most favored sector, the one which had 40% weightage in the Nifty, the banking sector. Banking has done minus 35.44%. If you put 100 rupees, you lost more than 1/3 of it, which is a terrible performance by any yardstick. Now to the only sector which did well. Pharma has stood out and made 16.44%, a positive return of 16.44% in the last 1 year. Interestingly, while this crash in the Indian market was engineered by a global crash, the international funds have lost only 2.22%. So if you had chosen to avoid India as a market and stuck to global and gold, you would have probably made money. So what does this tell us? It tells us that structurally our markets have been weak, and that weakness probably got exposed in Corona. Now this brings us to the issue of how can an investor interpret this? How do I make sense of this kind of a performance by the mutual fund industry? The first thing you need to accept as an investor is that the mutual fund industry is probably like Amazon. It gives you everything you need. It all depends on you and how you shop for your needs. So I would still think that the investor has to be a smarter shopper. Whether you are doing it on your own, or you're doing it through an advisor, or through some bank, or whatever, the onus of making your investments safer lies squarely with you. And the onus of choosing to take higher risks also lies with you. The advisor is expected, both by letter and spirit, to tell you what those risks are and how they can play out, and then you are to make the decision. This is how the entire advisory universe ought to perform. Now it's up to you to decide whether it's working in that way or if it ought to be improved, and then ensure that it improves for you. The most important thing which I believe has led to this poor performance is concentration of risk in one or two sectors. This always never ends well. In every previous bull market, concentration of risks in one or two sectors or in one or two teams always ended badly, and this time is no different. The fact that we built in all the positive assumptions into financials, overlooking the innate fragility of the business of lending, has led us to where we are. So we cannot expect that time will quickly heal this. Generally, if you take the example of 2009, when it was actually a global financial crisis where financials were the only things that were impaired, it still took a lot of effort for financials to come back over the next 2-3 years, and all the heavy lifting was done by governments. But this financial crisis is not just a financial crisis, it's a global economic crisis. And while governments will move to address the economic issues at a macro level, governments don't have the luxury of focusing on the financial sector exclusively like they did in 2009. So in that sense, the Indian stock market is structurally not in the right place. Or to put it differently, the Indian stock market structurally is at the wrong place at this time. So markets need to do a lot of heavy lifting to move out of this place that it finds itself in. So accepting that is the first thing that investors must do. I'm not sure that fund managers are going to accept this. In fact, it will take longer for fund managers to accept this than investors accept it. Why do I say this? The reasons are simple. Because structurally, the way today the investment universe is designed for the fund managers by SEBI, fund managers have no choice but to stick to this, what they're doing. They cannot walk out of this into uncharted territory. It's very difficult for them. You're going to benchmark them against a subset of stocks in which financials are still very heavy. They will continue to own them more than they ought to. And as the financials stay in the ICU for a long time, the investor is going to pay the bill. The fund manager is like the doctor, but the bill is going to be footed by the investor. I think understanding this is very, very important. And let me give you something which struck me very deeply over the last 1 year and which also was a bit of a pain point. I noticed that hardly a handful, far less than a handful of fund managers maintained portfolios without financials. And a very small percentage of them were underweight financials, which means that just like the small investors were herd in the small caps or micro caps, the fund managers were herd in the financials. They remain so. So if we are going to move out of this hole that we have dug ourselves in, the structure of the market has to change, and you need to see the financials move out or become less important structurally to our market. That is something that is not going to happen easily. So we need to understand that it is our responsibility as investors to choose products which de-risk our overall portfolio. So saying that I am happy if I beat the Nifty can lead us to a position where the Nifty can become a very big loser and we would remain losers along with the Nifty. I think that is not something investors are ready for. It is easy for a fund manager to say that Nifty lost 25% and I lost 20%. But I'm not sure that as an investor, you're ready for that. So your way of looking at it would be that I've invested for 5 years and this is my XIRR or my total return. And it's beating inflation by this percentage. So that would be the way in which you should look at your investments. If that is the way, then I think that you need to revisit your investment strategies and create an investment structure and strategy which will de-risk you from the risks of our market's current structure. So that should be the takeaway from the data that I presented to you about how funds and the mutual fund industry has performed in the last 1 year. You need to take the responsibility in your hands. Leaving it to fund managers or the industry is not going to work. What the industry tells you to buy will probably remain depressed for much longer than everybody believes in. While it may perform long into the future, I believe that it's going to be a painful road to buy what is popular in the eyes of the mutual fund industry. So you need to, while you need to use the industry, you need to use what they have to offer. You need to be very skeptical about what the industry popularizes. So that's a very peculiar situation which all of us find ourselves in. Whatever be our role, whether I'm an investor, whether I'm an investment advisor, whether I'm an RIA, whether I'm a distributor, or whatever role I perform, I think the responsibility is now squarely in our hands. And it's not going to be easy to just say that I'm going to do inky, pinky, ponky and look at some sites which give me star ratings or past performance and pick funds. It's not going to work. So you need to actually do a lot more thinking, a lot more introspection, and a lot more strategizing. Do continue to see the second and the third parts of this podcast, and I would be talking in more detail about specifics. Thank you very much for watching this podcast. Do share it with your friends. I do hope this triggers a lot of debate among all our investor friends. Thank you very much.